So that's okay. So welcome back, everyone. This is going to be part 2 of our Intro to Option Strategies class. Again, thank you all for attending. So briefly, just to quickly recap, we covered the basics of options. So, what's a call, what's a put, right to buy, right to sell, what the expiration is, what the intrinsic value is, at the money, out of the money, in the money, etc. We covered the 4 horsemen of the options Greek. So delta, which is the rate of change, gamma, which is the rate of change in delta. So how much your delta would change if the stock price changed 1%. We spoke about theta, which is time decay. So how much money you will either lose or gain depending on what side of the transaction you're on. And then we spoke about vega, which is implied volatility. So is everybody good so far? Hopefully, it's not too in depth. Tried to simplify it as much as possible. And then of course we just spoke about how you can buy stocks at a discount, right? By selling puts. So selling puts is one of the easier strategies. If it's cash secured, all that means is that you have enough money to buy the stock. So it's important that if you are selling puts, it's on stocks that you actually want to buy, okay? Don't just look for something with super high IV that you're gonna make, a killing on when you sell the premium, because remember, implied volatility is pricing in something, right? So if you're selling, puts on, I don't know, some small biotech company leading up to FDA approval, sure, you might sell, it might be trading at $5. You might sell, the $3 for, $1, but then it turns around, doesn't get FDA approval, and the thing drops to 30 cents. And before you know it, you've been exercised at 3 and it's now trading at 30 cents. I've seen it happen way too many times. So just a heads up, you want to make sure that you avoid that. Okay. So that was selling puts. And again, how you would do that, you go to option strat, you build your strategy, and this would be a cash secured put, right? So if you wanted to do it on, say, charge point, going out to July, it's trading at 14.40 right now. You can sell the 14 put if you wanted to buy charge point at $14.
For los carbs or like todo ese tipo de cosas.
You need carbs. Carbs is energy.
And
you have to eat carbs, but hay que quemarlo. ¿Entiendes? Pero no deberías comer tanto, porque mientras más comas, eso se final todo cantidad.
Solamente comí carbs 2 veces hoy.
No me da.
No, hacer tú literalmente no escuchas, like tú solamente hablas.
Yo no he dicho nada,
Sorry. Hey, you got a hot mic, bro.
Please mute their mics.
I'm trying to figure out how to mute it here on my end. Okay. For some reason, I can't find it here on my end. Okay. All right. So. Sorry about that. All right, so we have cash secured puts. So if you wanted to buy, say, charge point at $14, you can sell that cash secured put at, you'll get $137 for one contract. And so if it drops to 14 or lower, you'll get exercised on that. Your cost would end up being $12.63 per share, right? Which works out great. You're buying a stock that you want at a discount. The next thing that we spoke about were covered calls, right? So creating your own dividend. You'd have to own 100 shares, right? So you can see how you can buy 100 shares of stock by selling a put, right? And then you can turn around and you can create your own dividend on it. So if we go to something like ChargePoint and we say we want to build a covered call. So the same idea. So let's say we now bought ChargePoint at whatever, $14. Our cost was $12.63. We can turn around and say, okay, let's change the expiry to say August. We've moved forward in time. And let's say we want to turn around and we want to sell a call against that. Well, if you own the shares at $12.53, you can basically sell the 15 call and your max profit would be $438 per 100 shares that you have, right? And so you can see how you are basically creating your own dividend. You'll get a credit of $191, right? So you're selling that. Again, keep in mind, it's got a wide bid-ask spread, but then you can turn around and you can generate income from that. So if you bought it at $12.53, and then you turn around and you sold the 15 call, you can see how much you can start to generate from that. Okay? The further out you go in time, the more money you'll collect because you're basically selling time premium. But also keep in mind that the further out you go in terms of expiration, the less money you'll get. Okay? But that also means that if the stock price goes up, your max profit could be higher. So if you bought ChargePoint at $12.53 after your put got exercised, and you sold like the November 20, right? And it got up to $20 a share, you still made a pretty good return off of this stock. Okay? So this is just creating another dividend. There's a few things that you have to know and understand though. Okay, you have to be willing to accept to let the stock go, because if, say you sold the $15 call and it ran up past $15, well, you would be capped at $15 a share, which means at $15 a share, because by selling a call, you're short that call, which means somebody else can force you to sell it to them at that price. And so when you're selling this call, you've now taken on the risk that it gets exercised. If your cost was less than $15 a share, it doesn't matter because you're keeping the premium. But let's say you decided to do something not so smart and you sold an in the money call. Well, you can see that your max profit would be 210, but if it goes against you, you're going to be in a world of hurt. Okay, so if you're selling calls, as a general rule, please sell either at the money or out of the money. Okay, the further out you go in time, the more premium you will collect. The further out you go in strike price, the less premium you will collect, but the lower probability you have of being exercised. So if you really like the stock and you're not willing to give it up, then maybe don't sell calls against it, right? Remember, each scenario that you're in, you have to analyze what you're trying to do. But covered calls is a great way to generate income. And I'll give you sort of a cheat code here, right? So something like the Qs, right now trading at 288.74. We know a couple of things, okay? We know that the Qs or the SPY, the indexes in general, IWM is another great example. They're not going to go to zero. And so what I know a lot of professional traders do is they will hold a large position in something like the Qs or something like the SPY or the IWM, and they will generate weekly income from that. Now, this is a lot more expensive than, buying CLF at 19 or buying, SoFi at $4 or something like that. So you would need to have more money. But if this was something like, say, your retirement account, right? So like in my retirement account, for example, because I'm still employed, I can't actually sell options against it, but I'm either in an index fund or I'm in cash, right? So if you had a similar setup where, maybe you couldn't touch the money for a while, you could do something like this, right? It's a low risk way of generating income. Now, keep in mind, you want to be paying attention to time frame continuity and you know, a whole bunch of other things, because if it's just going to drop, maybe you don't want to be holding that for an extended period of time. If you're selling puts on something like the Qs, like here's a great example. You know, like next Friday's at the money put, right? So right now we're trading at 289. You can sell an at the money put on the Qs and collect $572, right? When you look at that percentage wise, it doesn't really seem like it's a lot. But when you start compounding this week after week after week, it could be pretty significant, okay? Especially if you bought, you know, some time ago. So if you think, you know, the market's going to continue to go down, okay, that's fine. You know, maybe you want to wait for some signs of a reversal before you start employing the strategy. But, you know, if you bought the Qs today at 288 and a year from now it's at 300, 320, 350, 400, we don't know where it's going to be, then you've got money already that you've accumulated because you bought the stock or you bought the index for less, you know, buy low, sell high. And then you can just turn around and generate income against that. So just keep that in mind, right? Again, it's you're going to need a little bit more money, but check this out. And the beauty of this is its scalability, right? So if you had, assuming you had a large portfolio, right, which is why I said, you know, it's people with larger portfolios that are doing something like this. You know, the index can't go to zero. It might drop in value. If you're not really worried about the underlying position itself, because you understand that 5, 10, 15, 20 years down the road, the index is almost less than 1% likely to be lower than it is today, then this is a great strategy, right? So if you had 300K, for example, well, you can make 5K a week off of that, right? So just, you know, think about something like that. IWM is another great example. You can do this with pretty much anything that you want, right? So IWM right now at 179 or 178, you know, you want to sell the put on it, you know, 286. So you can see how you can generate some money off of that. And then you turn around and you do the calls on it. Right, so again, QQQ right now, 288, you can sell the 290 for next week. So you basically be doing, and this is what I talk about when you have a larger portfolio, the things that you can do are almost endless, right? So imagine that you can be selling puts for next week, basically at the money, generating income on that side. And then once you're holding that position, you turn around and you sell calls against it, right? So if you had, you know, 1,000 and you're selling the call against it, right? There you go. You're buying here at the current price, you're selling the 290 call for next week, and you're generating $6,750. That is crazy if you think of that as just passive income. So once your portfolio gets, you know, 500,000, 1 million, 2 million, 5 million, you know, whether it's next week, next month, next year, 20 years from now, you can see the potential, right, of doing something just as simple as this. And with a cash secured put, you have the money up front to buy the stock. There's no risk on that side except, you know, holding it and taking a loss, like basically market risk, right? Because you can't diversify away systematic risk. Systematic risk always exists. And then you can turn around, you can sell covered calls on that. The downside is, you know, QQQ goes to 295. Well, you're selling at 290. You can roll your contract, but you have to be, it's a little more advanced, and you have to be buying back your initial short call and then selling another one. The idea with, doing a covered call strategy like this is that you want to generate income, right? So you would just be continuously rolling. If you want to maybe become a little bit more conservative, you can go to like the 300. Your max profit would be 12,990 if it gets to 300 by then. But if it doesn't get to 300, what happens? Well, you kept your $1,700, $1,730. So again, the further out you go, the less money you make, the lower probability you have of being exercised. The closer you go, right, the more money you can make. So just think about that. Something, it's potential for down the road. So you create your own dividend. That's the covered call. You can also do what's called a married put. This is basically like buying an insurance policy on your contract, right? So let's say you have the Qs and you are deathly afraid that the market's going to crash. You can buy a protective put, okay? And so what that means is that you are long your shares and you are buying a put to protect yourself. And so the closer you go to the money, right? So like with insurance, you choose the level of coverage and the time you want to cover it for. So let's say, it was back in, like the beginning of the year, and you were holding Amazon stock or Tesla or Nvidia or whatever. And you thought, okay, you know what? Maybe the market's going to take a dive. And you don't necessarily want to sell your position for whatever reason, right? Well, you can buy a protective put. It's called a married put. It's basically an insurance policy. So what you're saying is that, okay, I own this at $288.74. And if the price drops, I want to be protected. So what you could do is, it would cost you $488 to buy the 287 put for next Friday. But that means that if it goes below 287, you're pretty much protected, right? So your max loss would only be 662, as opposed to not doing this. And, you can basically see how if it drops down to 280, 270, whatever happens, you're now losing a fair amount of money. Okay. So that's just, again, something to consider. So what have we spoken about so far? We buy a stock. We bought a stock at a discount. We chose the price that we wanted to pay for the stock. Right? Here's a great example. Let's say right now, sorry to switch up the tickers, but let's talk about SPY, because a lot of us have been trading SPY. We know that SPY has gone down. We're now down on the week. We're close to triggering the month, so on and so forth. So let's say that we want to buy the index, right? What does Warren Buffett do? Do you know how Warren Buffett generates hundreds of millions or billions of dollars a year? He sells puts on the index, right? So right now we're trading at 389. Let's say we want to buy it down at 380, right? And we want to go out to, well, you know what? Let's do something even crazier than that. Let's say we think the market's really going to tank. And we think that, you know what? It's going to get down to 360. Well, you can take that position on now, collect $1,169, but remember you're tying up $36,000 in buying power, right? So it's something that you can do, if you're feeling a little bit, more aggressive, or you think that the market might turn and rally. You don't think that it's going to stay below 380 for very long. You can sell that, collect your $1,800. If it drops to 380, you buy at 380. If it doesn't, well, you collected the $1,800 and you kept that. Okay. So you sell a put, you buy the stock that you want. If it doesn't go down to that price, you keep the premium. If it does go down to that price, you're buying it and your cost is actually less, right? So if you actually did that, your cost would be $361 on the stock, or sorry, on the SPY. Okay. So then you turn around and you say, okay, well, I want to generate a dividend. And so you start writing covered calls against that. So you got paid to buy. You're now getting paid by creating your own dividend. And now you can protect your position. But you can actually do both. It's what's called a caller. So you can buy a put and you can sell a call to finance your insurance strategy. And let me just find it here. Why do we not see? Oh, here, caller. Okay. And so the same idea. You sell the put. Oh, sorry, you buy the put, so that acts as your protection, and then you sell the call. And the idea is that you are protecting yourself in a certain range. Okay, so if you want to protect your downside, and you basically, like if you're holding a large position, right, in the index, and you don't want to be subject to huge swings, right? So if you're trading, I don't know, if you got a boatload of Tesla, right, and you know how Tesla moves, well, if you want to hold the stock, you can buy a put, which protects you to the downside, and you can finance that by selling a call. Now, again, every strategy has its benefits, but it also has its risks. What's the benefit? Well, here you're protecting yourself to the downside, but you're also capping yourself to the upside, right? So if you just want to say, hey, I'm willing to, give it a little bit more room, well, you can see how you can do that. So you're basically buying an insurance policy here to the downside, and you're financing that policy by selling a call to the upside. The idea with the caller is that you want to try and have one offset the cost of the other. Okay? So everybody good so far? Any questions? All right, so if nobody has any questions now, let's get into why I think everybody was here today. So hopefully you found value in what we've spoken about so far. But now let's talk about spreads, okay? Spreads are, for me, an amazing way to turn a little into a lot, right? So before I was in the Alpha Pack, I did a lot of spread trading. And, when you, like my thou wows that came before Alpha Pack were basically from spreads, because when you're purchasing a spread, what you're basically doing is you're buying a call, so you're long a call, but you're also short another call against it. And so the downside is that you're limiting your upside potential, but you're also limiting your risk, okay, which is always a good thing. And so when we're talking about spreads, there's vertical spreads, there's like the debit spreads, credit spreads, diagonals, butterflies. I mean, you can just go to option strat here and you can look at all of the different types of spreads. What I will tell you, okay, is anything you do, be careful, make sure you understand how the strategy works and what you can do to fix it if it goes wrong. Now, this is well beyond the scope of what we're covering in the first few sessions. But if you see, you can go to option strat here, for example, and you can optimize based on, whatever you're looking at. So if you think like you're very bearish on the SPY over the next, couple of weeks, so let's go out to July, you can actually come up with a strategy. Well, it will optimize it for you, or you can come up with a strategy. So, hey, you can get a 380 put, and it'll cost you 886 bucks. And if it drops down to 320, well, you make a huge percent return. But this is what I like, right? With a spread, you can actually get pretty good returns without having to put up as much risk. Okay, so let's talk about spreads. First of all, there are different kinds of spreads. There's a credit spread where you're basically getting paid. So it's like selling a put, but then you have another further out of the money put that you've bought as protection. So there are people who will sell credit spreads to generate income. Because if we do something like the SPY, and we went out to here, right? So remember how we spoke about selling a put? Actually, what was the example we used? Charge point? Let's go back to that just so that we're kind of on the same page. So let's say that we wanted to sell that 14 put, right? We know that it would have cost us 50, we would have collected 59 cents, right? But let's say that we don't necessarily want to buy it. We just think that it's going to stay above a certain price. Well, if you sell a put credit spread, so let's say I am bullish on charge point. I think charge point is going to go up. You could sell a put, right? That takes a lot of capital because if it's cash secured, you'll need $14 times $100, sorry, times 100 shares, which is $1,400. Or you can sell a put credit spread. So you're selling the 14 and you're protecting yourself by buying the 13.50. Your max loss would be $34. Your credit would be $16, and you're using significantly less margin. But it is risky, okay? Before you start getting into, selling put credit spreads, you have to understand the risks. So I'm going to share a video in the resources tab. Actually, it might already be there, about how it can go wrong. Because remember, every time you get into something like a spread, there is the possibility of something going against what you think might happen. So, there was a case where a guy was selling, $1 wide spreads on Tesla. And so he sold the put credit spread. Or it might have been a call spread. I don't remember. Basically, what happened was one of the legs got exercised. And by the time he realized what had happened, the market had already closed. So he got exercised after hours. The market had already closed. He wasn't able to offset his position with his long call. So his short call got exercised, his long call, he couldn't. It ended up costing him $30,000 for a $1 wide spread. So what I will tell you is that any time you have a spread, especially if you are collecting a credit, don't be greedy, okay? If you collected 16 cents and if on, June 17th, you can buy it back for a penny or two, always, always, always buy it back, because anything can happen after hours and you could end up in a situation where you're losing more than what you gained. Now, credit spreads are high probability, low profit, okay? But remember, all it takes is one of them going against you to wipe out weeks or months, or potentially, if you really somehow manage to mess it up, years of progress, okay? So whatever you do, please, please, please be careful. This is a valid strategy if you're looking to generate income. If you want to buy the stock itself, you're better off just doing the cash secured put. But this is a directional trade, right? So if you are bullish, so let's say we think that charge point is going to go up. We can buy the stock, we can buy a call, we can sell a put or do a put credit spread, or we can get into a vertical spread, okay? So let's introduce the vertical call spread, right? So this is called a bull call spread. And how this works is we are long a call and we are short a further out call. So for this example, let's use the July expiry. And the thing with these spreads is that you can generate pretty consistent returns if you're right about the direction and the timing. And so what I'll tell you is this: if you're looking for consistent returns, okay, 50, 100%, it's very possible with debit spreads. You're not going to have the huge returns because remember, you're selling a call, but the difference here is that you're capping your profit. So if we did say the 15-16 call spread, so I'm buying the 15, I'm selling the 16. If it's above $16 at expiry, I max out my profit at 170%. Still not a bad trade at all, considering it's costing you $37 and you can make 63. Okay. But here's the thing. The further out you go, the higher percentage return you can get. So let's say that I think ChargePoint's going to do a face ripper and it's going to go from $14.40 to over $19. Well, you can see how this trade will cost you 15. You can make 85. That's not bad at all. Okay. But it has to make that move. If it doesn't make that move, the closer you get, the lower the probability is that it's going to make that move. So if it just chops around here, $14, $15, $16, if it doesn't get above 19, we're not going to max out our profit. And if it's not above our break even of $18.50, right, which is $26, sorry, is 26% higher from here, you're not going to make anything, right? So the further out you go, the lower probability you have, which is why we use the strat, okay? So first and foremost, how do we use these strategies, okay? The further out you go, right? So if I go with something like the 1920 for August or November, right? You can see how it ends up costing more, which means that my total profit is less, but I'm still making, 300% if it does that. You don't have to do $1 wide spreads, right? So let's say I'm very bullish on ChargePoint. I can do something like the 15-20 call spread, which means I'm buying the 15, I'm selling the 20. The max that this spread could be worth is $5. So it's going to cost me 138. I can make 362. Where you really start getting these crazy returns is when you do, way out of the money call spreads on something that, if we're looking at, let's use PBR as an example. You know what, here, let's do this. So these are trades that I've actually either spoken about in the group or I've, put on myself. Actually, most of these I shared. So, here we can see that there are some that are losing. PBR had a decent day today. And because of the volatility and time decay, this is actually up 103% today, but total return, we're still down. So when they start working, right, and I haven't shown you butterflies yet, but here's an example of, XLE and XOM. So back at the beginning of May, we looked at XOM. I said, okay, hey, the July 15th, $97.50, $100 call spread, which would have been way out of the money at that time, I took this on, or when I shared it, it was May the 2nd. We're now above $100. So this spread will not be able to go above $2.50 as the max value, but it's up 279%, right? But I've limited myself. But by doing that, I was able to, right? It cost me 39. My max profit's 211. So as long as I continue with this and it stays above $100 by July, my total return would have been 541%. Now, mind you, if at the beginning of May you would have bought just a regular call, you probably made more money, but your percentage return might not have been as high. So this is one of those things where you're going to turn a little into a lot. And you can see how, even though my spread has already maxed out, I'm only, we'll call it halfway there in terms of the max percentage return. Because remember, I'm long a call and I'm short a call. So the longer I keep holding this, as long as it stays above 100, my return is going to increase day by day by day by day. Okay, so how do we actually look at this and apply this? Right, so let's look at, somebody give me a ticker that they're looking at, and we can put a trade together here. So just type a stock that you want to go long on or short on, it doesn't matter. KO. Oh, Miss Nikki, how are you? I'm glad you made it. All right, so you're bullish on KO. So this is the daily, right? So we can see here that we're up on the day. I'm assuming you want to buy calls, Nikki, is that correct? Good evening. Okay, so right now we're trading at 61.41, right? And so when I'm looking at these and I'm trying to create a spread, so here, we've got a 3, 1, 1, we had a 2 down. So we're looking for some sort of reversal into continuity, right? Or at least flipping all this back to green. And so what I do is I look at the magnitude, right? So when I'm trying to structure this trade, I want to think, okay, well, if I'm looking at a weekly chart, how many weeks do I need for this to flip and to go higher, right? So 4 weeks, 6 weeks, 8 weeks, I always like to err on the side of caution, right? Buy more time than you think you need. If you think you need 4 weeks, buy 6 weeks. Because even if you're right, and it gets up to 60, so let's just use the top of this 3 here as our magnitude, right? $66. Well, if it gets up to $66 and I have the $67 call, well, guess what? It expires worthless. So how do I structure these trades in such a way that it makes it worth our while? So we have Coke here, $61. We go back to option strat and we start building our spread. Right, so if I go to KO, 61.40, and let's say that we want to go out to August. Well, if I do something like the 62.50, 65 spread, it's going to cost me 94. My max profit is 156, or percentage-wise, 166%. But if I'm going for the magnitude, I would want to go with something like this, right? So if I think that it's going to reach that or even go to, these highs here, then I want my short strike to be at my magnitude. And I want my long strike to be beneath or below my magnitude. The reason for that is I want my spread to end up with my long call in the money and my short call at the money, if possible. If it ends up in the money, that's fine as well, right? Because you're going to max out on the spread. But if we price something out like this, this will cost you $51. Your max profit's $199 or 390%. Now, it's going to cost you less, right? So if we compare, just buying a call, right, for August, it's going to cost you 98. And if it gets up to that level there, you're looking at 168%. Right? If you go to 6750, of course, and it gets to 68, well, then you're looking at, it's not really even, well, at $68, you're basically just breaking even. Right? So when you do the spread of the same sort of dollar amount, you can see how, because you're selling this one here, you're basically financing the cost of your call. So that's one way to think of a spread is I want to take advantage of, this upside move, but I want to use less money to do it. At the same time, realizing and accepting that you're capping your upside. Okay? If you want to be like super conservative and go with like, something that has a much higher probability of success, well, then you go with just a closer expiry, or sorry, with a closer spread. So here, we're 6140, 6250, 65. If it's above 65, you'll max out your profit, but that's still 166%. So not bad. And, the further out in time you go and the further out in distance you go, right? So let's look at something like, I love Mara. And, if I think that by January, Mara can, like, if I think Bitcoin, say, for example, is going to rally, and I think, okay, well, if Bitcoin rallies, then Mara is going to rally, and I think that it can get back up to like $25, right? Well, you can do something like the 2025 call spread. It's going to cost you $25. Your max profit's $475, and that's all the way out to January. So if I think that Bitcoin's going to turn around and take a face ripper rally and it's going to get back to where it was before, well, that's 1900%. Right? But also keep in mind that it's got to move quite a bit. So when you're doing spreads, that's buying the spread at one time. So you buy to open and you sell to open. You can do this in one transaction. Okay. The other alternative is that you can leg into a spread. Now, if we go back to our example of Coke, right? And let's say we got the August and we bought, say, the 65 call, and it goes up in value, right? So let's say here we bought the 65 call at whatever, 50 cents, hypothetically speaking. And then you turn around and you sell that 67.50 call, right? So let's say you were already long calls, right? And you're up 100% on your calls. You can leg into a spread. You can sell that 67.50. Your cost or your risk is only $3 now. And so by legging into a spread, you're actually able to protect your capital. So if I'm up on a trade, and keep in mind that when you're trading spreads, you need certain requirements from your broker. So it might be passing a test, it might be having a certain dollar amount, so on and so forth. But if you leg into a spread, so let's say you're up 100, 200, 300% on a trade already, let's say you bought the 60 call and you're, a few dollars in the money. You can sell a call against that, and you can actually set it up in such a way that you cannot lose money on that trade. So you only have upside potential and no downside. So if you have, a portfolio that you're aggressively trying to grow, you can do that with spreads. because what you're doing is basically taking your money out and letting the trade still ride. So imagine, you bought your $65 call, you're up 100% on it now, you bought it for 40, it's now 90. Well, you could turn around and sell that 67.50 call, and your max profit could potentially be $247. And I've had situations where the spread has actually ended up in a credit. So I actually got paid to make money on that trade. So, for those of you that are trading longer term contracts, this is something that you definitely want to consider. Okay. By legging into a spread, you're financing the cost, or at least getting capital back by selling that short call. Now, again, keep in mind that you would be limiting your upside. But if you think, hey, you know what, this is getting up to a broadening formation, right? Or, we spoke about exhaustion. You think if you believe in that exhaustion risk theory, then, you can say, hey, well, I still want to hang out in this trade. I still think that it has potential, but now there's a whole bunch of chop. Well, if you don't want to get caught up in the chop, leg into a spread, take your money out. You've now lowered your capital commitment. And if it goes up further, great. And if it goes down, well, you've already taken out most of your money and you've only got $3 at risk for the potential of making another 247. So that's just the vertical call. It's the same thing on the downside. If you think that KO is absolutely going to crash, or, let's use SPY, because most of us here are in the camp that SPY is going to puke. So here we are at 389, right? We look at where we think SPY can end up. Right? So we're 2 down on the week here, obviously already. But if we go, say, 2 down on the month, and we break below here, right? So this will trigger 2 down on the month. And so if we start looking at, where our targets would be, depending on how far out you want to go in time, potential targets. So let's say right now, you think that SPY is going to go 2 down on the month. Now, keep in mind that, we still have another 2 weeks, or slightly more than 2 weeks for that to happen. So you have to buy enough time on your contract. But if you think that that could happen before the end of the month, you can set up a trade like that. Right? So let's go back here to option strat and go to the end of the month. We're looking at 380. So if I think that's where it's going to end up, I would do a bear put spread. Right? So I think that the price is going to go down. And so my short strike would be the 380. And then, if I really want to be sort of adventurous, you can do something like the 382, 380. If it gets down to that 380, your percentage return would be 190%. Okay, so that is just an idea. Again, it's costing you $69. Your max profit's 131. If you think it's really going to puke and you want to go out further in time, let's say by October, we think that it's just going to be, murder, death, kill, and it's going to get back down to like 315. Well, hey, guess what? You can structure a trade like that for very little money. Right? So for 55 bucks, if it did manage to do that by October, you're looking at a potential max profit of 800%. Right? So that's the spread. And of course, if you leg into this, you know, you can get that well over 1,000% easily. Right? So if you bought the 320 now, and then as it went down, you know, you sold the 315 at a later date by legging into a spread, you can actually lock that in and probably end up even with a credit. Okay, so that's your spreads. There's also what's called a diagonal spread. And a diagonal spread, so right now we have the same expiration. But let's say you think that, hey, maybe the SPY is going to go down, but I don't think it's going to go down that much or that quickly, right? Or most people think to the long side. So let's go back to our KO example, just to make it easy. So you can do what's called a diagonal call spread. So again, we're looking at KO. So we'll go back to the chart here. And so I think that we're going to go, you know, 2 up, and we're going to clear all this chop and so on. But while I'm waiting, I want to start building a position. So with a diagonal call spread, what you're doing is you're buying a call and you're selling a call, but you have different expiries. So you are buying a call that is further out in time, but closer to the money. And you're selling a call that is out of the money. All right, so let's go with July as our example. Again, we've got the 61.40. Right, so let's say I'm going to buy the August. I'm going to sell July. This doesn't want to cooperate. Hang on a sec here. And so this is another way to generate some premium if you want, or you can, there's a bunch of different things that you can do with this here. So here I am long, and then here I'm going to go to August. All right, so now I am long the August 60, and I would be short the 62.50 for July. So now we have 2 different expiries. And so what I'm anticipating here with the idea behind this, or the thought process behind this, is I think it's going to go up, but it might chop around for a little bit. And so the least that I want to do is reduce my time decay, because what's happening here is you have a short call that is closer to expiration and out of the money. And you have a long call. In this case, you're in the money. So if we change it up a little bit, make it look something like this, same idea. So we're thinking it's going to go up to where we want, and we're not wanting to get caught up in the chop. So you can buy the 62.50 for August. So you have enough time on your contract. You're selling a shorter term one. So as long as it doesn't go above 65, you're fine, right? But even if it does, you still have a fair amount of profit. And so this is another way to generate a little bit of an additional return. So you're long here, the further call, you're short the closer call, because time decay is higher the closer you get to expiry, and you're further out of the money. So you're reducing your risk. So it's almost like a covered call on your underlying position. Some people will call it a poor man's covered call, where you're buying a deep in the money call. So instead of buying stock, you can buy a deep in the money call and do the same thing and get the same result for actually less money, if you think about it. Okay, so that's the diagonal. Any questions so far? Okay, the last thing I'm going to show you, and then we'll call it a night because we've been going for almost 2 hours, is the butterfly. Okay, so far every trade that I've shown you has been low risk. The butterfly is also low risk, but you're basically combining two spreads. Okay, and so how a butterfly looks is you want to, so let me think about how I want to explain this to you, because when it comes to butterflies, you are looking at a target, okay? The wider the wings, the higher probability of profit, but the less money you're going to make. Okay, so think of this as you're shooting at a target that is, 50 yards away, 100 yards away, 200 yards away, 300 yards away, 600 yards away, right? So if we use the same example of KO, and we think that it's going to get up to, those highs of 67.20, you can do what's called a butterfly. So butterfly is where you are long a call, you are short 2 calls, and you are long another call. A typical butterfly, the wings are the same distance apart, right? So if we go about 70, just for the purposes of this illustration, so say I think it's going to break out to new highs. You know what? I'll do this, which is probably easier. So $2.50 wide. So my target, my magnitude here, where I think it's going to reach, is going to be the 67.50, right? So the all-time highs. And if it does that, you can put this trade on for $19. And if it gets to and pins at that magnitude at expiry, your potential return is 1,205%. But remember, this is a target that's far away. And so and this is the great thing about option strat, is you can actually look at the probability distribution based on their calculations. But when we're looking at the strat, we're looking at magnitude. So we know if this goes, 2 up on the week next week, that it's likely to trigger, this and, flip the month and so on and so forth. And then we end up with our magnitude here at the top of this 3. Then we'd use that for our body. So the body of a butterfly is where we are short those 2 calls. Now let me explain this to you. Okay, we have a debit spread and a put credit spread combined. Right, so we're long a call debit spread and we're short a call credit spread. When you are putting a butterfly on, you do it as a spread. When you are taking a butterfly off, you're doing it as a spread. Don't think, oh, hey, you know what? I'm short these 2 calls. Let me take my profit on the long call, because I don't think it's going to get up to 67.50. You do that, your trading career is going to be over before you know it. Because if Coke does spike and you are short those 2 naked calls, you could be in a lot of trouble. Okay, because remember, what we're doing is we're putting 2 strategies together and benefiting from time decay. Okay, and so with a butterfly, you're just casting a net. Here you have a small net, and the wider the legs, right? So if you go 62.50 and 72.50, you've now got a $5 wide on either side. So it's a $10 wide butterfly, which if it pins here again at 67.50, that's 437%. When you're doing butterflies, you are not going for the max profit, okay? The max profit is just an indication of if everything goes according to plan and I hit this bullseye at 600 yards, this is what I could potentially get. So if I was doing a $10 wide butterfly on something like Coke and my max profit's like 450%, we'll call it, or 437. If I'm at, 200, 300%, I'm looking to take that off. Okay. Maybe keep one runner in case you want to try and pin, but expect to take profits at half of whatever your max potential is. And if you go super narrow, right? So 250 wide. Remember, this is a $5 wide net that we've cast. At expiry, it's 1,200% if it's at 67.50 exactly. But before that, right? If it moves in the next 2 weeks back up to where it was, you're still going to make, 200, 300% easily. So with butterflies, think of it as, more like tossing a hand grenade and trying to just get it in that particular area. Okay, so you want to be close, but you're not looking for absolute precision, even though you could, and try and pin it. But $19 max loss for a potential profit of 231, which if I go back to my saved trades, you'll see the highest potential return. So here's this SPX August 19th butterfly, put on a couple of weeks ago. That was the return on the day for one of these. Okay. Today's return, 2,730%. Now, if you had 10 or 100, you can do the math on that. Okay. Again, same thing here. Like if you would have put this on today, that's what your return would have been. Your total return here, you're still up 67%, and you've still got a long way to go, right? If you were to translate this over to SPY, it would be the 370, 380, 390 put butterfly. SSCO, you can see here, put a butterfly on a while ago, a couple of weeks, really, 127%, 100%. Look at the other spread. So the whole idea here is, even though, we've got some losses, like this CLF butterfly, the 33, 35, 37, it's for October. So if it does get back up to there, look at your potential return. Right? Assuming it does make a run. So if I was to put that on right now at $4 to potentially be able to make almost 200, there you go. So you can play around with these. Anything you do, before you take the trade, run it through Option Strat. It's free to use the calculator. Run it through, make sure you understand. And then when you're putting it on, when you're getting into that trade, get into it with the understanding that with something like a butterfly, you're not looking for the max risk, right? So if, we'll use CLF again as an example. Say I think it's going to get to 35 and I go with the 30, 40, again, I could make a 700% return, but the closer you get to expiration, again, because of the time decay, that's where you end up. Okay. So hopefully this has been a valuable learning experience for you guys. Does anybody have any questions on anything that we've covered? Is there a particular ticker that you're looking at, maybe looking at putting a trade together? Nikki, actually, what we'll do is let's save our Coke trade here. So let's build out our Coke. We'll do a bull call spread, and then we'll do a butterfly. We can just track it to see how it's doing. So we'll go to August, we'll go with the 62.50. Okay, so we'll just save that trade. We'll take a July, same one. We'll go with this here, 65, 67.50. We'll just save a few of these just to see how they work out. Right, and we'll put a butterfly on here as well on Coke. So again, Coke, same idea. I'm going to pin it around the 67.50, I think the magnitude is. And we'll do the $2 wide, or 250 wide. Save trade. There we go. Okay. So if anybody wants to, give me a ticker, I can, give you a couple of trade ideas, sort of what I would be looking for. The main thing is that when you're putting the spread on, if it's a vertical spread, you want to use your magnitude as your target. So that's usually where I try and put my short call or my short put, is at that magnitude. Because if it does reach there, and I'm looking to take that off, I'm looking to take that off at the max profit, right? Which is where you would find that. So if your short strike is at the money, that's okay. But what I will tell you before we go, I have to give you another warning. With debit spreads or any spread, your short strike, so if you end up in the money on your short strike, you can get executed. And so a few years ago, I was trading, I had a JP Morgan spread. I was long a call. So let's say I was long the 145 and I'd sold the 150. And when it got to 150, I got exercised. So now I was short, in this case, $250,000 worth of JP Morgan stock at that price. Now I was fortunate because, I had the underlying, and so I could, offset the trade. But if you're not prepared for that, you don't understand the risks, you can get yourself into a lot of trouble. So to recap, what do you have to know? You have to know what the risks are, what the benefits are. You can take, a bunch of different trades based on your setup, right? So if I'm bullish on Coke, I can buy the stock, I can sell a put, I can do a put credit spread, which would reduce the amount of margin that I have to put out. You can buy a call. So either in the money, at the money, out of the money. You could do a diagonal. You could do just a regular vertical call. Again, you can do close to the money, out of the money, basically at the money, out of the money, or really far out of the money. You can do a butterfly. Like, there's a whole list of things that you can do. Cater or tailor, I should say, your strategy to what you feel about the underlying, right? So like, for example, when we took the SPY trade yesterday, I wanted to go with a higher delta because I was trading it in my new small account that I had started. So I didn't want to take the risk of buying out of the money and it going against me, especially considering it expired today, right? So I bought this yesterday. So I took like the 409. And then of course today, you know how that worked out. And then I took the 350, the 390. And then I, took my profits on that. But keep in mind that especially if you're trading short-term options, you have to get the move that you're looking for. You have to be right in terms of not only direction, but distance and time. So anytime you're looking at putting on spreads, make sure you're giving yourself enough time. right? Spreads are a great way to go further out in time with less money, right? So if something is super expensive, right? So say you don't want to spend, we look at Coke, right? The August calls. If I just go with the July, 65 call, that's $98. If I go 62.50, that's 192. Well, say I don't want to spend $192 per contract. Well, I could do a spread, right? So in this case, I can sell the 65. So now my cost is half, but I've limited my upside. That's the most important thing to understand, okay? Is that when you're getting into a spread, you're limiting your upside. But of course, by limiting your upside, you're also reducing the amount of risk that you have. So is it a worthwhile trade-off for you? It might be. What I can tell you is that as you're learning these spreads, start with going a little bit further out in time and a little bit closer to the money, right? And then once you understand how it works, then you can start doing things like legging into the spread or, going with further out of the money, things like that. Okay. So that's it for me. If you have any questions, comments, concerns, complaints, or donations, feel free to let me know. I'm going to stick around for a couple of minutes to answer any questions. But thank you all for attending, and you know where to reach me if you want to ask me anything directly. That's it. Thank you all. Yes, both recordings should be posted. Bankroll. So can it work with the 0 DTE? Yes, potentially it could. I personally don't recommend it. Right? Give yourself time. You could. I mean, like if you would have done an SPY 0 DTE today, like $1 wide, it might have cost you. Oh, here, you know what? Let's do one better. Pull up an example. Right, so let's go with a bear put spread on the SPY with Monday's expiry. Okay, so if on Monday, we're opening up sort of close to where we are here, and we want to do a bear put spread. So what I would want to do is, so let's say I'm targeting 380. You could do something like this, right? So it would cost you $9. And if it dropped to 380 on Monday, your max profit would be 91. As opposed to just buying that 380. Oh, sorry, we're buying the 381. So let's do this. Well, no, because we want our short strike to be there, 380. So that's right. So the 381 would cost you 56 cents. The 380 is costing 47. So if you were going to take a 0 DTE and take just the 380 or the 381, it would cost you $56 for 0 DTE. Here you can do it for 9. Now, if SPY absolutely pukes and drops to 375, you're going to hate the fact that you did a $1 wide spread. But if that hits, right, like that's a thawa for $9. So you buy 10 of these, it costs you 90. You come out with, almost a band. Not bad. So you can do them with 0 DTE. It's a lot more difficult to do. You have to get that move like that day. Right? If you want to do something that's, less aggressive, again, same idea, say you think it's going to get to 384, right? Which is not really out of the realm of possibility considering the moves that we've seen recently, right? So if it does go to 384, you're still looking at 400%. So you can play around with that idea and see how it goes. All right, so that's it for me. It's 12:35 a.m. here on the East Coast, or Eastern time zone, I should say. So I'm going to head out. If anybody has any other questions, feel free to reach out in the Discord, and I will answer your questions whenever I get a chance. So take care, everyone. Thank you, and have a good night.